So, what's harder to predict than the weather in Cape Town? Well, currently, the global market, when half the world is going on holiday this week, from China's National Day to India's bank holiday, traders might find markets moving slower than a Monday morning coffee queue. But let's not quite get fooled just yet. There's still plenty bubbling under the surface. So before you place your next trade, watch this. Good morning. I'm Francois, your market analyst here at ATFX Africa. As the final week of September begins, global markets are entering into a period of unusual dynamics. Not only do traders face ongoing debates over US monetary policy and policy uncertainty, but this week also brings a series of major public holidays across Asia that will significantly affect liquidity. When fewer participants are active in the market, prices or price movements can become sharper and less predictable. Against this backdrop, key themes that stand out today is the Swiss franc's resilience, silver's remarkable surge, and the Nasdaq's 100 is ongoing momentum. However, let's kick things off with the elephant in the room, which is our economic calendar. This week is packed with public holidays that could thin out liquidity across key markets. Kicking things off on Wednesday, the 1st of October, which is National Day in both Hong Kong and China. And this would mean that instruments such as the HK50 or Hong Kong stocks will be closed for the day. On Thursday, the 2nd of October, another holiday in China, plus India joins in with their own bank holiday or their own day off, which again could affect liquidity. And then on Friday, the 3rd of October, China remains closed and South Korea also takes a break with their version of National Day. So, what does this mean for us as traders? Well, with fewer participants in the market, price moves can sometimes exaggerate a little. Think of it like driving on an empty highway. You can go as fast as you want, but one wrong turn could be costly. It's a reminder to keep an eye on volatility spikes and not to assume that quiet equals calm. For more or details, check out the link in our description to visit our economic calendar. And with that, let's kick off today's instruments with the USD CHF. The Swiss franc has been flexing its safe haven muscles once again, edging below 0.8 against the US dollar. Why? Well, the dollar's been on the back foot after strong US data cooled expectations for aggressive Fed cuts. Meanwhile, the Swiss National Bank decided to hold its rates at 0% after 6 straight cuts since March 2024. That's like a marathon runner finally stopping for some water. Policymakers flagged weak growth and tariffs as risk. Most economists now believe that the Swiss National Bank is done cutting, and no negative rates aren't making a comeback anytime soon. Looking at the technicals, USD CHF currently sits around 0.796, down 0.13% on the day. The franc has been trending firm, up 0.51% in a month and nearly 6% stronger over the last year. If 0.8% remains a ceiling, traders might eye the support at 0.7925, of which a break could open the door even lower towards 0.786. While a bounce back above 0.8 might relieve some dollar pressure. Moving over to commodities, and I feel on this specific one, I've been saying the exact same thing for the past 3 weeks. Silver just hit a 14-year high, above $46.50 an ounce. But this shiny commodity just keeps shining brighter and brighter, and here's why. A softer dollar with looming US government shutdown risk and investors piling into safe havens, and add the fact that there's a supply squeeze with 5 straight years of deficits, with demand outpacing supply by over 100 million ounces, and you've got a recipe shinier than a brand new wedding ring. Markets are also betting heavily on a Fed rate cut, with a 90% chance in October and a 65% chance in December. Looking at the charts, silver popped to $47.19 an ounce, up 2.17% just for the day, and is currently trading around $46.74. That is 15.5% higher over the month. And get this, more than 50% up year on year. Resistance currently sits at that high point around $47.20, with the big psychological level of $49.50, which is the 2011 high, looming as well that ultimate target. On the downside, $45.20 and then $44 could act as support zones if profit taking starts setting in. Finishing things off with the Nasdaq 100. Now, this specific index has been grinding higher despite a looming government shutdown that could stall key data releases like Friday's non-farm payroll. Yes, folks, you heard that right. If the Republicans and the Democrats don't come to an agreement very soon, we might not have NFP this week or even this month. On that note, however, indices are holding firm, buoyed by Fed cut expectations and last Friday's inline inflation numbers, which was the PCE release. But don't forget, tech stocks just snapped a 3-week winning streak. Investors are cautiously optimistic, but the volatility switch is always just a headline away. Looking at the charts, currently trading around 24,620, up 0.44% on the day. The Nasdaq has gained over 6% in a month and nearly 23% in the past year. Key resistance currently lies at 24,800, while support holds around 24,500. If the shutdown drama drags on, we could see some choppy price action this week. But for now, the bulls seem to have the upper hand. So what should you keep an eye on, tomorrow? Well, with Asia holidays kicking in midweek, liquidity could start thinning out faster than an office fridge after payday. That means volatility spikes are possible even in normal, quiet sessions. Tomorrow, we'll see how that plays into the market's mood and whether silver keeps its sparkle or takes a breather. And with that, we wrap up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to ATFX Africa by clicking the link in the description and go and experience the difference for yourself. It is until next time, stay sharp, stay focused, and trade smart.